Okay, let's get right into it. So this is something that when we think about the three pillars of wealth, and Jennifer created this with the triangle, and it's so beautifully done because most of the time when we think about building our wealth, we think about investing, and we're looking at the top of the triangle, which would be public equities, so stocks, bonds, index funds, etc., because that is called Wall Street. That is the main way that people are taught or marketed to, and frankly, to build wealth. Nothing wrong with it. It has a really important place in the portfolio. However, it's the top of the triangle, and the foundation of wealth building actually resides in non-correlated assets. A lot of times this type of investing is called Main Street. So that also includes like private equity, real estate, commodities, golds, alternative investments. And then the other area, the other foundation of the triangle is risk management and other financial tools, which is where Jennifer resides in her profession. So life insurance, and actually I will say using life insurance as an investment tool and not the way most of us think of life insurance. But today, and you can see the recording that we did a couple months ago where Jennifer presented on risk management. It's very important. But today we're going to focus on real estate. So in short, why real estate? Like, why is everybody so interested in real estate? Historically, it is the #1 way to build wealth. Anecdotally, I think everyone has heard that real estate is the way to build wealth, and that the wealthy for centuries have grown their portfolio and built wealth through real estate. Endowments and institutional investors. So we're talking like multi-billion, trillion-dollar funds, including pension funds. They hold about 25% of their assets in real estate, more or less. The Yale endowment model was the first to make kind of like to bring this forward. And today, I think they're sitting around like anywhere between like 8 to 10%. The value of real estate. So why real estate? It's worth about $60 trillion in the US. And that's between, and this is what we're going to talk about, residential real estate and my world, which is commercial real estate. And the thing about real estate is that you don't have to be an institutional investor to own or to understand it. Real estate tends to be the most accessible type of investing. And in short, we get it. I mean, you talk about a home, you talk about a property, you say, I understand that. I can wrap my head around that. I can wrap my arms around that. A lot of times, and I'll say it this way, we think we can't understand more sophisticated financial instruments. That is inherently not true. They're not that complex, most of them. Some are, but real estate's just like tangible. It's like this thing, I get it. I understand it appreciates in value, and I understand the value of real estate. So it holds a place in our psyche and in our society, and it definitely holds a place in our portfolio. So this is something that most people, I think, don't really know, and it's really important. How the wealthy, the ultra wealthy, make investment decisions, essentially. So this is from Tiger 21. It's an asset allocation report. Tiger 21 is it's like a club or a group. And you can belong to this club or group if you have a $10 million net worth or more. In general, the wealthy and wealthy portfolios don't put the bulk of their money in the stock market. And they certainly don't put it in index funds. They put the bulk of their money in real estate and in private equity. And the big reason for this, and the reason these two go together, I'll just say really quickly, is the cash flow component. Because the cash flow is an income hedge. And this becomes a really important part of why real estate is such a wonderful investment. So just know that, especially if you're working with a financial advisor, real estate belongs in your portfolio. And this pie here, this is not like your primary residence either, by the way. Like, this is outside of it. This is entirely your portfolio. So real estate returns, real estate returns are generally higher than the broader market. And when I say broader market, I mean like the stock market. Historically, real estate outperforms the stock market. And, you know, over this time frame, going back to say January of 2000, if you were investing in commercial real estate through REITs in this case, your returns were actually almost 3 times higher than the stock market. So that's over a longer time period, which is important. I know that the stock market prior to about November of last year had been on a massive tear for a few years and was outperforming everything, but it's important to take your investment horizon on a much longer timeline. So another thing when we think about real estate returns is that real estate outperforms during periods of high inflation, and especially privately held. So not REITs, actually REITs underperform, but privately held multifamily and industrial were the ones that over time here had delivered the strongest risk adjusted performance. And a lot of this has to do with inflation and also just a level of risk. Real estate generally is not as volatile as stocks. So these are really important aspects here, like the risk adjusted, which we'll talk about later, is one of the most important sort of terms that you want to think about and learn and know when it comes to real estate. So I'm just going to give a little bit of an overview here of post-pandemic real estate. It's no secret that we have record home prices since the pandemic across absolutely every market. Home buying demand has surged. And even today, as we record this, like home sales numbers came up, and where Wall Street analysts had been expecting a 5% decline in home sales due to the tight supply and rising interest rates, it was actually only down 2.7%. So there's extraordinary demand, not a lot of homes on the market, driving prices up everywhere. So we have, especially post-pandemic, we have very strong housing market. The pandemic, when it first happened, everyone thought we're going to have the great financial crisis again. We're going to have a real estate crash, and it did not happen, not even close. Forbearance and mortgage default did not happen, continues not to happen, even though the forbearance periods are over. And that's homeowners and renters. We did see some lower rent collections in certain areas, certain types of assets. Definitely depends on your tenant base, but there has been no severe downturn. If anything, it's even in commercial real estate, which we'll talk about, everything just keeps going up in price. So rent collection remained high. Everybody paid their mortgage. Everybody paid their rent. So one of the big differences between this time and 2008 is that there was not excess leverage. There was not excess debt on any kind of property, which is why there were not a lot of defaults. Lenders are prepared for this. Lenders understood that they're not going to do they're not going to let that happen again. So they were more careful. And you also didn't have a huge subset of people that own 2, 3, 4 properties at, 90% loan to value. So this is really important when we think about, is it a bubble right now? It's actually not. This is what we're going through right now is a function of the extra liquidity in the system from Fed money printing and inflation that is being created from this. So what that has done, because there's all this extra money that has come into the financial system. So banks lend that money that the Fed printed, and it's being purchased by large investors, and it kind of goes down the line. But basically, at previously lower interest rates, investors go and invest that. So we've seen stock stock market inflation due to this and asset inflation due to this. And so you have all this extra money in the system. Well, it's being poured into assets, and commercial real estate has also experienced tremendous growth. There was a little bit of softness in retail, so malls and hospitality. But even where a lot of people thought all hotels would default and die, they did not. And actually, statistically, you know, in the past, like 6 to 9 months, like hotel occupancy is higher than it was pre-pandemic. Another thing when we think about investing in real estate is that more people are renting today than at any other time in the last 50 years. And this is not going to change, actually. More and more, the US is becoming a renter nation. There's affordability issues. There are a lot of factors. It's a whole economic discussion that goes into this phenomenon. So the rental market has been growing like crazy. Honestly, like certain areas, rent growth is 20% year over year. You have a lot of people moving from higher priced metros to lower priced metros, and they'll pay the premium because it's still less than what they were paying in like New York or LA. And so you're getting all this money and all these people going to other places, and rents are just going up and up and up and up. And all of this is partly due to the great pandemic migration. People moved with the ability to work from home. People moved and they can work from anywhere. And there's going to be a continued like flexibility in remote work. So all of this is just driving, people are moving all over the place and trying to buy and renting, and just, it's created just a flurry of activity. And so along with the, let's say, inflationary environment, it's created a ton of demand. There is a shortage of new housing coming on the market. And so you essentially have a supply crunch, which drives prices up, whether it's rents or property prices. So real estate is an inflation hedge. And so this is the number one reason that real estate is so highly valued by investors. You know, we are looking at a stated 8.5% inflation by the Fed in the month of March, with how it's calculated today. If you calculate inflation the way it used to be calculated in the 80s, and you can go to shadowstats.com to see this, inflation is more like 20. And it probably feels that way to most of us, right? And just so, for example, you know, looking at progressive numbers, the inflation in March was 1.2%. So that if you have to annualize that, that's actually 15%. So we are in an extraordinarily high time of inflation. And what you're seeing is real estate, so asset prices, real estate assets are going up as inflation goes up. And this is their relationship to inflation, which is why real estate is such an important thing to have in your portfolio. So some of the other benefits of investment real estate. So I'm talking outside of your primary residence. I personally do not consider primary residence an investment because it doesn't cash flow. I mean, unless you can put an ADU on it and rent it out. Like if you can make your primary residence work for you, fantastic. I love that all day long. But I'm not talking about primary residence right now. I am talking about investment real estate. So cash flows, the ability to charge and collect rents. Rents also appreciate with inflation. So you have the income hedge. So that's the growth here: capital appreciation, rental income appreciation. There's no correlation to the broader market and traditional equities. So they're completely decoupled. So the stock market can do whatever it wants. Investment real estate just doesn't even, they're not even on the same planet when it comes to the way that they move. It historically outperforms the S&P 500. With investment real estate, you can diversify across multiple assets and geographic locations. You can invest in different categories of real estate, different cash flows, different areas. So you can really build a defensive portfolio with real estate. that acts as an inflation hedge. There's some great tax advantages to investing in real estate, whether you're doing it directly or through through a syndication. Essentially, the ability to write depreciation off of the passive income. So in many cases, you don't actually pay tax on the income that you're receiving from rents. One of the best things about the way that you can invest in real estate today is that you can leverage the time, experience, infrastructure, and knowledge of experts. Because the thing that is so important, and I think it's on a slide later, but basically is who's got time to do all the work involved in like managing real estate. So on this list here of real estate investment options, oh my gosh, there are so many. I mean, Airbnb alone created a secular change in real estate. It created a whole new industry that, again, is not going away. Short-term rental and vacation rentals, and the ability to do remote work is unlikely to be something that ever really goes away. And there's a whole industry around it. So a lot of people are doing or interested in short-term rentals, vacation rentals. You have commercial real estate options, so apartments, retail, self-storage, medical office. Commercial is comprised of several categories, senior housing. You can do single family long-term rental. I'm sure many people have or would think, and a lot of people start with, I'm going to buy a second home and I'm going to rent that out. That's how most people get started. You can do land or farm or agricultural investing. That's another subset of real estate investing. Ground up development. So construction development. REITs, this is the most accessible, right? Because they're, some of them are not traded, but some of them are. So they trade like stocks. So just something to be aware of. And then crowdfunding. Crowdfunding was an industry that I helped to launch back in 2013. And that's really how I got started in real estate investing. So crowdfunding crowdfunding really just brought marketing to real estate syndication, and a lot of technology and a lot of transparency. Crowdfunding companies operate a little bit differently than, let's say, like a private equity firm like mine that does syndication, but they have done a lot of wonderful, wonderful things to make private real estate more accessible to more people. And like we saw before, private real estate outperforms public real estate as well. And so down here in the pink, you can see we've got these two categories essentially, which is active real estate investing and then passive real estate investing. And so what that means is really, it's the level of work or activity that's involved to be in real estate. So on this matrix here, we have, your barriers to entry, which can be significant. And then we also have the work involved. So, your highest work, highest barrier to entry is going to be commercial buildings as a general partner. So, it's not a lot, but like, let's say a $10 million building, but like $100 million building, $1 billion building. So you have really high barriers to entry when it comes to the money that is required if you were to say alone, I'm going to go buy this building and then manage it. Like you're managing 100 units, 200 units, 500 units, or like you're managing a mall. Really high barriers to entry, a lot of work. Lower barrier to entry, a little bit more accessible, but still a lot of work, is going to be like short-term and long-term residential rentals or vacation rentals. So I know when I was doing short-term rentals, like it was a lot of work, and it's probably not very suited for the way that I operate, but I did it. It was fine, and I very much prefer passive, like having done the active. And what's not in here on the active side actually is also like fix and flip. So renovating and reselling. And then you have on the low barrier to entry and passive, you have REITs, which I mentioned, which are publicly traded publicly traded vehicles where they are professionally managed, very large buildings. So like you might be looking at like multi-billion-dollar buildings in New York City, for example. And then private syndication. So private syndication up here in the upper, my right-hand corner, is into commercial real estate as a limited partner. So the barriers to entry here are a little higher because there's a cost or like a capital requirement. So, and this is what crowdfunding actually really changed, where even with my firm, like it's a six-figure entry. But with crowdfunding, like you can get into some commercial real estate for like $1,000. And so that's like a gateway that helps you learn, that helps you get into it. So we have your active and passive, but it's also the most passive. You just sit back and you just basically like collect your distributions on a monthly, on a quarterly basis. You don't do any of the work. You're a limited partner. So the challenges of investment real estate, like out of all of this that we've talked about, and all the benefits that we talked about, like there's great benefits here. There's also a lot of challenges, which, as I mentioned before, it's time. So if you're doing direct investment of any kind, it's active. It's a lot of work and you need a lot of expertise. You need funding and financing. If you're doing value add, you need money and abilities and skills and people to do rehab and renovation. There's property management. Relationships is a really big part of it. And so like knowing the right people, knowing the right lenders, real estate brokers, et cetera, like you need a professional team to help you succeed. And a big challenge is the illiquidity. So most of the time when you're investing in private real estate, you can't get your money out. Like it's in the building until the building is sold or refinanced. And capital requirements. So generally speaking, there's a lot of money that's required up front when you have to purchase a building. So passive real estate investing is my favorite type of investing because I don't have to deal with tenants or toilets or trash or lenders or anything. I come in as a limited partner and my job is to fully understand what I'm getting into and vetting the partner that is in charge of the deal. And that, like, that's my work on it, which still requires, it is some work, but it's definitely worth it. But I don't have to do all the heavy lifting, let's say. And so this is where you leverage expertise. So the expertise is the person that is going out and buying the building and managing it and doing the work. Basically every building or every transaction is like its own business plan. So, I find companies and people that are active investors. That's called an operator, a syndicator, private equity, or crowdfunding. That due diligence piece, like, what am I investing in? And the number one thing is, who am I investing with? That is massively important. And then knowing your investment goals and your strategy. So this probably should come like first out of everything. In general, when we're investing, is like, what is my why? Why am I investing? Like, what are my goals? And how does real estate fit into those goals? For me, real estate fits into goals that I have around creating other streams of passive income. I'm not that interested in creating more streams of active income because I can't duplicate myself. And the whole idea is to work less and have my money work for me. So I like passive real estate investing that cash flows because it can do that for me. And in general, with passive investing, I get to keep my time and get my returns. So how does syndication work? So how does it work when someone else is the active manager, or they are private equity and they have the buildings and they're doing all the work? And this is called syndication. This is where if I'm the operator, I'm going to do everything and I need some money. So I'm going to syndicate, I'm going to push this deal out and raise capital from other people that are the limited partners. So the passive investors are the limited partners. So their job is basically, like I said, like your job as a passive investor or limited partner is to do your due diligence on who you're investing with. But really that's it. Like you have no job as far as this real estate project goes, but your capital is at risk. So the money from passive investors goes into the investment opportunity, the building, and it's all managed by the general partner. So that's a syndication. It's an investment vehicle where a group of investors pool capital to purchase an asset. This works really well for large buildings, of course. And syndicated investors are passive partners, and they're relying on the experience of the operating partners to execute the business plan. The reason why, and syndication has been around forever. I mean, I remember when I started working in crowdfunding as a founder, and we would go around and say, "Oh, we're gonna change the real estate industry," and let me tell you, real estate does not change that fast. And I remember meeting all these syndicators and they were like, "What are you kids doing?" And we're like, "We're going to change the real estate industry with crowdfunding." And they're like, "Yeah, it's called syndication. And we've been doing it forever and ever and ever. You're just using a website and the internet," which is true. And now all of them use websites and the internet. So it's kind of interesting how it's really just some technology and just some evolution, but real estate fundamentally does not change. The fundamentals of real estate do not change ever, which is why at the end of the day, understanding those fundamentals is really important because they will never change. I don't care what comes along later. Tokenization, that's going to change it. It's not. Real estate will always be the same because it's based on the same fundamental principles, just like economic principles. So this pooling of capital is a very efficient way to participate in a larger investment. So I can put in $100,000 and make returns on like a Class A building, let's say in New York, that is considered super safe, and just like these returns are always coming in. Whereas if that wasn't possible, I don't have $10 million to invest in that building. So this is really the opportunity that syndication brings. So the sponsor's role, the sponsor is the operator, the general partner. They are the active participant. They are the tenants, toilet, trash, lender, construction manager. They are all of that. They are responsible for the execution of the investment. So they are the ones that interface directly with investors, brokers, property managers. They are finding, purchasing the property, doing all the financing, managing the operations. They pay investors the returns. They list and sell the property and then give investors back their final returns. And they get a percentage of overall investment proceeds for doing this. They also usually and should always have some skin in the game. They should always have some of their own money in the deal. But essentially they're going to get paid for doing all of the active management, which is a percentage. It shouldn't be more than 30. There's some egregious fees out there that are being charged, but generally speaking, you want to see like a 70-30 split, where 70% goes to the passive investor. After a preferred return. The sponsor also, when you're thinking about this for yourself, should be highly qualified, and they should be properly incentivized to execute on the business plan. So they should always have skin in the game. They should get paid their larger fee, that 30% I was talking about at the end when they sell the building. So imagine that you work with somebody and they manage to basically get the equivalent of all their money out in year one. How are they possibly incentivized to see this through to the end so it's as successful for you as possible? So this is what I mean about incentivization. And they should also be incentivized in terms of like making enough for it to be worth it for them. So the more moving parts, the more that a best-in-class sponsor is the partner that you want. Simple investments, that a lot of people can do simple investments on the active side, but when you're talking about a really complex property, and a complex business plan, you want a really experienced sponsor. And their level of expertise most definitely influences the success of an investment, and the level of your returns, because there's a lot of variables that will affect your overall investment returns. The investor's role is, so that's us. So our role as a passive participant is to provide capital. And that's pretty much it. That's what we do. We receive monthly or quarterly returns. We have this fractional ownership in a limited partnership. So this also, it's a great benefit because it offers liability protection. And then we get tax benefits, like depreciation and capital gains treatment of total returns at the end. So capital gains are generally taxed at less than your nominal rate. And even though we're not actively managing the property, there is a responsibility that does fall on our shoulders, as with any kind of investing, which is like know what you're investing in is really what it comes down to. Know yourself, know your goals, and know what you're investing in. And with real estate, this is potentially more important, right? Wall Street has almost like conditioned us to give away our agency and just like, oh, stick it in an index fund. And if you leave it there for long enough, like over time, like your 401k will grow and all this kind of, all this kind of stuff. But do any of us like really know what's in our index fund? Do we understand the cyclicality of, economy? Like right now, you probably want to be in different sectors than 2 years ago. So there's some things that we should know anyway. So with real estate, it's even more so because commercial assets can be highly complex. And the way I think about it in a really practical way is, if I don't understand some of the basics, when I start to get my returns, or like sometimes maybe a distribution doesn't happen because, let's say, Q2 of 2020, when COVID hit, we weren't really, most sponsors, most of our partners, like we did not issue distributions because the plan was hold on to every dollar that's coming in just in case something gets worse. But if you don't know how things work, you might freak out. And that's just like, it's not worth it. So doing that, having that upfront allows you to have more control over your response and your emotions in case things don't exactly go the way as planned, because there's a lot of complexity to real estate. And it's not, it's not always going to go exactly the way projections are showing, because projections are that. They're like, we think this is going to happen based on these factors, based on these numbers. So really understanding it up front, it's just better for us, as investors. So you want to conduct due diligence, which is mostly, for me, it's around trusting the sponsor, trusting the people that are responsible, for executing on the business plan around this building. Their track record, is super, super important. Basically, I heard somebody say this really well at a tokenization panel in Miami, and they said, like, there is no magic bullet to real estate. The magic bullet is your track record. And I 100% agree with that. And knowing the right questions to ask and not being afraid to ask them, right? This is everything. But I tell everybody that, including my investors that speak with me, I say, like, anything, there's not a stupid question. And that helps us get a level of confidence, in asking questions and getting information. And also the sponsor, or the crowdfunder, or whoever it is you're working with, like their willingness to answer those questions or to point you in the direction of some information, because there's plenty of information also. So the role of an intermediary firm. So for example, Alpha Investing, what I do, we would be an intermediary firm of sorts. We're a private equity firm. We pick sponsors. So we basically connect the sponsors that we pick to work with on the buildings, on executing, to passive investors. So in a way, from that perspective, the passive investor isn't trying to understand a ton about the sponsor. We are the ones doing all that work. So we interface with the sponsor. We create the LLC. And that's a really important piece of this. We handle all the legal, administrative, all the asset management, reporting, distribution. And the number one thing that an intermediary firm, whether it's a private equity firm or a crowdfunding firm, or a capital raiser, a broker dealer, is the underwriting and the due diligence. That's massively, massively important. And it's a lot of work. So just to finish off before I jump into questions, I see that there are a lot of them. Real estate is an investment that works for you. And that to me is everything. Like, I want my money to work for me, and it does. So there is currently a macroeconomic environment, and the markets are pushing a lot more capital into higher risk investments. And that's causing increased volatility. We can see that in the stock market right now, and it's penalizing the safety, let's say, of cash bonds and interest-bearing investments. And I stutter around the word safety because cash is not safe. With 8 to 15 to 20% inflation, you're actually losing that. Bonds are horrible right now. And there are no interest-bearing investments, let's be honest. So like right now, where can you put your money that is kind of safe, solid, that gives you returns, that is not volatile, and that actually increases with inflation? And honestly, the only thing that is real estate. Because here's the thing, you work hard to build your business and to grow your wealth. There are options that help your wealth grow, no matter the market. And so to me, understanding real estate investing and the role it plays in your portfolio, for whatever your goals are, whether it's generational wealth or cash flow, like, it's really important to have even a basic understanding of why real estate belongs there, especially for those who may have financial advisors who are not incentivized to tell you about real estate or to encourage you to invest in real estate, because they don't get a cut. And this is the truth. So smart diversification in the right assets, like private real estate, not only helps you mitigate risk, but also preserves capital and diversifies returns, and it diversifies your sources of income. And with that, I'm gonna wrap up so that we still have lots of time for questions. So remember that everything we do here, this is our wealth cornerstone. Finance, investing, your financial foundation should not be an afterthought. And women, we really need to learn and better understand financial concepts, so that we can gain access to opportunities for growing and enjoying money and wealth with grace, joy, and ease. So as we like to say, women of wealth, it's time to shift out of working for my money and moving into my money works for me. And as Jennifer mentioned at the beginning here, the lion's share of $30 trillion in financial assets is expected to be controlled by women by the year 2030. And we do these Wealth Mastery every month. Linda, thank you so much for graciously hosting us. And I'm gonna stop sharing my screen, and we can dive into some questions.